This is a view inside the account during live trading hours. You are looking at the month-end results for December 09. The cash balance at the start of the year, that being 01 January 2009, was 58,380. 58380. If you take the profit of 91,300, I'll just use a round number. That's 91300 divided by the start of year cash balance of 58380. You get a return for the entire portfolio of slightly above 156%. That's 156%. That's about 13%. That's 13% return per month. This trading account was configured as a multi-asset class portfolio. With the traded products, you see, for example, DBP, metals, which is a commodity index. TBT, the 20-year Treasury Bond Index. The FXA, this is the Australian Dollar Currency Exchange Traded Fund, an ETF. So I did not have to trade currencies separately, but I traded the options on currency ETFs, in addition to a broad-based equity index like the DJX. As the portfolio was structured using traded products from multiple asset classes, I'm going to benchmark its relative performance against indexes across equities, currencies, commodities, and bonds. So I've selected year to date as the period for comparison using the perf chart at stockcharts.com. This is the full year's annualized performance from 31st December 08 till 30th December 2009. For equities, that's stocks, I'm using the Dow Jones, the SPOOS, that's the S&P 500, the most widely accepted performance benchmark for equities, and the Nasdaq 100. For currencies, I'm using DBV, representing a basket of the G10 currencies, which includes the greenbacks, that being the US dollars, euros, Japanese yen, Canadian dollars or the loonie, the Swiss francs, the Swissy, the Great British pounds, Australian dollars, the New Zealand dollars, the Norwegian krona, as well as the Swedish krona. For commodities, the benchmark used is GSG, the iShares Global Commodity ETF, which tracks 24, that's 24, different commodities across energy, agriculture, industrial metals, livestock, and precious metals. And finally, for bonds, the benchmark is the iShares Credit Bond ETF, the exchange traded fund, which represents only investment grade credit sector of the United States bond market as defined by the Barclays Capital US Credit Index. With the annualized return of 156%, the portfolio did beat these external benchmarks in terms of year-to-date performance. In hindsight, you can argue that instead of diversifying across the asset classes, why not just use long call options in the MNX, the mini version of the NDX being used here as a benchmark index, given that the Nasdaq 100 did rise more than 55% year to date. The problem is you do not know how a sector within equities, that is a sector like technology, of which the NDX tracks, within equities as an asset class will perform for the entire year until year end. Moreover, if you sunk your trading capital into one index alone, like the MNX, even if you were doing a mix of short iron condors, credit verticals, and long debit calendars, you are exposing your trading capital to the concentration risk of only one sector and within only one asset class. You have not diversified the price risk specific to each traded product in your portfolio. Aside from the external market benchmarks, now let's have a look at how the retail portfolio's gains of 156% measures up against professionally run hedge funds. HFR, this is Hedge Fund Research. This firm specializes in the areas of professional index trading and analysis of institutional hedge funds. So looking at the year-to-date performance of these indexes, and if we just go down according to the indexes across all the different asset classes, the humble retail portfolio structured in the study room with its 156% year-to-date gain has beaten institutional hedge funds across all the different asset classes, including hedged currency funds. Going back into the trading account, even before you calculate the metrics, characteristically, what makes for a consistently managed portfolio are these following characteristics. The largest loser, that's 1053, does not wipe out the largest winner. The largest winner in this case is 6,400. Above the value of the largest loser, that being 1053, there are many more winners, and the winners are progressively much larger in their profit value. For the entire account, the profits should step up gradually, depending on the size of your account. If it's in the tens of thousands, the profits should step up consistently like a ladder from the low hundreds to the higher hundreds, then from the higher hundreds into the thousands. And if your account is in the hundreds of thousands, profits should step up from the high hundreds into the thousands, then move into the much higher thousands. Profits that jump from the low hundreds directly into the thousands signal an over-reliance on gapping plays, which fail to help you step up consistently profitable results. I've calculated the portfolio metrics, that is the win-loss probability, the number of wins per one loss, the average win to the average loss, the performance ratio, and the positive expectancy per trade. That you can see in the static screenshot on the website. At every month end, this view into the account and the metrics are updated, so you can see the year-to-date performance